Well, for more on what's happening on the markets, joining us now is Gina Bolvin, president of Bolvin Wealth Management Group. Thanks so much for making time for us today, Gina.
Thanks for having me back.
So when you're looking at the momentum that we're seeing on U.S. markets recently, I mean, 8-9 days of gains in a row for the S&P 500 and the NASDAQ here, albeit very small gains today, but still this streak continues. What do you make of it?
Well, I think that 2023 is the year of the consumer, and I think it's, it just speaks to the resiliency of U.S. businesses and the U.S. consumer. And I came on the show in January, and thought that it would be a good year for the market. I said as such. I thought most of the gains were going to come at the latter half, whereas most of the gains came at the beginning. And I'm not surprised, and I really do think that this is going to continue. Tonight, we're looking at Disney, and we're going to see how Disney stock is going to do with their subscriber growth. And we're really looking for some more insight into the consumer to see how strong they are, to see how willing they are to spend.
Yeah, I'm just taking a look at some of the results as they cross the wire here for Disney, and maybe I'll read out a few of them. Disney saying that its subscribers for Disney Plus came in above expectations, so 150.2 million. The estimate was 147, so beating there. It's talking about cost savings. It's on track to achieve $7.5 billion in cost savings. It had seen $5.5 billion in cost cutting previously, so increasing those cost cutting efforts for Disney. Looking at Hulu and live TV subscribers, that was a hair higher than expected, 4.6 million instead of 4.5. ESPN Plus, about in line with expectations. Total Hulu subscribers were a touch lower. Let me see if there's something else here I can pull out. Entertainment operating income was quite a bit higher, 236 million instead of 164. But if we're looking at, sorry, it's a lot of numbers to throw out here, but if we're looking at adjusted earnings per share, was a big beat. So 82 cents versus 69 cents. Fourth quarter overall revenue, though, came in a touch below, 21.2 billion versus 21.4. So yeah, a lot of numbers to go through because there are so many different parts of Disney these days, Gina. Anything that jumps out to you from those so far, or others that you would be looking deeper into?
Yeah, well, so I don't have those numbers in front of me, and I'd have to digest them. But I think we want to take a look at earnings season as a whole. And I think we can say that the earnings recession is over. We're more than halfway through the earnings season. It's been good enough. And I think that we're on to more growth. Earnings growth is going to continue into 2024. But I do think regarding earnings, the worst is behind us. We've seen an 88% beat rate, which is pretty good in average. And I think we've cleared the earnings bar.
Interesting. Yeah, well, we'll wait to see what the reaction is to Disney, seeing in after hours that it is up a bit and pointing to that profit beat and the additional cost savings as possible reasons. We're going to dig into that more, though, coming up later. Microsoft is a company that you've been watching recently, and, for the ninth day in a row, it's also on a streak of gains, too, for Microsoft. But one of these companies that has really been, leading the charge this year. What do you think about Microsoft these days?
Well, I mean, it hit an all-time high today. So how can you not love Microsoft? It has an AI tailwind. One of the best companies out there. We do like mega cap tech, and a lot of people are talking about the Mag 7 and how they've done so well this year. But it isn't just necessarily this year. These magnificent 7 stocks have beaten the market and have done better than the S&P 500 and the NASDAQ over the past 5 years. So there's a tremendous amount of momentum to continue. And, I have to say that even if you're just neutral on technology, That's 30% exposure. So if you have 30% exposure to technology in your portfolio, that's a neutral weighting. So that's a lot.
Yeah, do you think that these tech giants, as Microsoft, for example, will continue to have these sorts of outsized gains, or that, if you're saying the earnings recession is behind us, will we start to see perhaps that being felt more broadly, that breadth of the market?
Yeah, what we saw last week was an impressive participation with the small caps. The reason that's Russell 2000 is the index, and the reason that's so important is because that's almost like a recession indicator. Small company stocks are very interest rate sensitive, and they're economically cyclical. So if you think we're going to avoid a recession, then you would invest in some small company stocks. I think it may be a little early, but that is a part of the market that you would want to watch as a recession indicator.